Hey, welcome everyone. John Person here. Thank you for joining us this afternoon. I think we got a game changer coming for 2016, as we like to say, and it is a game changer because there's a lot of things happening right now. And I thought it would be nice to review some of these and just to kind of give you a more insight of the tools and the techniques that seem to be giving us an edge in the markets. A lot of just before we begin, just take a quick glance at this disclosure, which is important. Just remember, past performance is never indicative of future results, regardless of what my inbox says. Jokingly speaking, of course. I always like to input a little bit of humor. Many of you have known or seen me through the years. Any event, game changer. What do we got going on? What is happening right now? Let's take a look at what the market is faced with, what we're faced with. First and foremost, the United States is about ready to enter uncharted waters, at least uncharted for the last 9 years, and a potential interest rate reversion mode. In other words, going from a zero interest rate policy to possibly a rate hike on December 16th. That's next Wednesday. So the markets have been held hostage, markets meaning the equity markets. People want to kind of focus in on how much borrowing costs, what is it, the cost of doing business when if interest rates go up, and what does that mean? Fear always keeps markets on edge, and fear begets selling, and that's why we do get corrections in the market when someone sneezes. It seems to me, without any statistical backtest study, that the market, right before almost every single FOMC meeting, the markets had a sell-off, as if it's a child in a temper tantrum trying to threaten the parents that it wants what it wants, or it's going to start crying. And that's what the market seems to, and I'm only speaking out of experience with grandchildren here, but it seems that that's what the market's kind of doing. This time around, slightly different, because we do have some drag effect on the market, namely China. I always look back and I go, man, if you could only turn back the clock, which we did, correctly analyze this. Remember in the summer when everyone was talking about how Greece was the culprit, and it really turned out to be China, right? So China's projected GDP is supposed to contract to possibly going into 2017 now. There's a big economic report that came out that suggests that China's economy, not only will they be a economic contraction, their GDP is forecasted to be maybe as low as, you're going to love this number, 6.1% through 2017. We have Europe in a quantitative easing mode, QE, again, quantitative easing mode. And we have, unusually, again, all year long, it's taken all year for crude oil to get back into this mid-30 level. And you remember that the market was anticipating $20, and then it shot up to close to 50, and then it came back and moderated in the 40s for quite some time. Low oil prices depresses Russia's economy, who depend on oil sales. So there is a reasonable expectation to see what should be bad for one country should be good for another, right? But that's not really the case. And we do have a commodity price depression. And the question begs, is it oversupply in the case of lots of commodities, metals such as aluminum, copper, again, oil, crude oil prices, right? Is it oversupply? Is it under demand? We also enter a time frame, if you remember our presidential running candidate for the Democratic Party, Hillary Clinton, and a lot of other folks talking about how drug companies were gouging consumers. Remember, so U.S. regulatory pressures on drug companies is an issue out there. Heightened security, which means defense spending could increase due to now heightened protocol over terrorists acts globally. And then now we enter 2016 with an election year spending that may give back again a seasonal event of media stocks a boost. Everyone's going to be on the campaign trail. Everyone's going to be spending money on commercials. And that money is what helps propel the presidential election cycles, as there is some spending. And we also see that that switch rotation of where focus will be. So election year spending is on the horizon here. So just things to consider as we move into net 2016. However, what do we do towards between today and next week to the end of the year? We can all speculate and say how the market's going to react to December 16th. But to be honest with you, the Federal Reserve, we all know this is a quick reference point. We all know that the Federal Reserve has backed every investor into the equity markets. If you wanted a rate of return on equity, you invested in the U.S. stock market. And that's why we have seen a very strong sense of uncertainty in the marketplace, which has also bred a heightened amount of non-sustainable trends in the market. Mainly something we pointed out in our trading room, it seemed over the summer and the fall that any stock that made a 3 to 5% move, man, if you didn't take that move, if you didn't get out of that trade, it seemed to have reversed on you. Case in point is just the recent upside move over the last week was in the airline stocks. Look what they did today. It was supposed to be a positive thing of lower oil prices for the airliners. And look what happened to airline stocks today. So I think the whole key is we are walking on eggshells, and the market, as I wrote about, many of you probably got an email, which our planning and scanning was a precursor to today's session, was that the market is a hostage to the Federal Reserve. But I think what we can count on is one of two of the last two bullet points that we should start to look at. Seasonal New Year profit-taking correction, only because of tax deferment into 2017. So the stocks that are typically near their 52-week highs have a tendency not to decline into New Year's significantly. And with the exception of Green Mountain Coffee Roasters, stocks that are near their 52-week lows tend to see buybacks after the beginning of the new year. So companies that might have solid earnings but got beaten up, they still look good. They have a function of consumer demand. One product, and I probably may get blasted for this one, is Twitter, for example, may see its final upside or some kind of recovery in prices after the new year. It seems to be showing some stability, which, for the record, yesterday we entered in a longer-term option strategy on Twitter, kind of a directional biased upside position to capture exposure to Twitter, but yet also maybe if it recovers a bit and moves sideways, it gives us, for the next 30 days, we have a longer duration vertical call spread on for that reason. There are a lot of technical reasons that I'll go over today that have been extremely helpful into determining markets, and I think we all have to be a little bit more on our guard for some of these potential opportunities. And the tools and techniques that we've used, well, not every single trade we do is right around here. That's, for sure. We tend to get the big moves. And many of you have been in the room, and I have most of my clients still here with us today. Examples are such as even the last week's move of the euro currency. And I'm going to go review that and share with you what I find interesting. I don't think that the key is to look at chart analysis alone, and it's definitely not a good idea to use lots of price-based indicators. And I think we have to look at a combination of what we call non-correlated indicators. We absolutely should be looking at multiple time frame analysis and market condition analysis. That's a big word, that word condition. Condition is, for example, something I wrote about many years ago, the last conditional change. Look for markets that break out. We need to see not just a breakout, but we need to see markets close above specific resistance levels. Also, condition also reveals and refers in my work as to when it's when we're looking at equity indexes, breadth analysis. And breadth analysis has been very important in helping us to determine this wild market ride. And believe me, it's been a wild market ride. and we'll go over that real quickly today. I think 2015, many of you have seen me either present in person throughout the year. I made a lot of really nice trips and met some really fabulous people. And a lot of feedback just of what I got, whether it was the from Long Island to San Diego to Seattle to, I know the West Coast, we had a great bunch of people, a lot of TradeStation and TOS users out in California, from San Francisco all the way up or down in this case to Southern California. A lot of people actually have had a feedback to me that they had a tough year because a lot of people were option writing, and option writer strategies didn't work well in this environment. We saw earnings go ballistic again, and the irony is that most people are conditioned with a low implied volatility market. You know, it didn't give a lot of things, and we saw big switches in the market. I don't know how you feel, but that is something that I think was an interesting situation. Short-term directional trades seem to have worked out the best, except for when it comes to a few stocks, such as, and even look at Microsoft, which just in the last 60 days exploded off the charts. Microsoft of all markets. But of course, Amazon continues to reign supreme. Facebook still maintains its highs or near its highs. Netflix as well. So those are still, and those might be the ones that I think that as we get into 2016, the typical January correction, the stocks that have maintained near their 52-week highs, those are the ones that are susceptible for massive profit-taking corrections. So we want to examine those closely, and how we examine those are the tools that I'll share with you today. So I think one other thing that was extremely helpful in the overall market was one of the best contrarian indicators was the commitment of traders data, COT. It was extremely useful. In fact, it was one of the powerhouses of looking for the key reversal in the euro currency, why we were positioned with FXE calls going into for last week. And I want to share something with you right now, if you don't mind, because I know crude oil is a big thing that people are looking at, right? Two things that I've already teed up because I got a lot of information and I just want to go through it with you guys. This is the Commitment of Traders report, and this includes, number one, it's found on our website. I'll share that with you later. It's this includes, as it says here, options and futures. So if you're looking at the underlying ETF, you got to be, or an ETF, you got to be looking at the underlying commodity prices, and there's a specific tool that can help us. You can clearly see, look at the imbalance here, 250,000. Now this is as of 12/1. What was 12/1? It was Tuesday. When did the ECB and the market rock? Thursday. So this data still reflects what the positions were, net position of commodity traders and futures options combined. Note that hedge funds, look at this amount of shorts in relative to the open interest. I mean, they had literally almost 50% of the open interest, and it shows here percent of open interest. They had almost 50% of the total open interest hedge funds, which are speculators, they were short. Check this out, almost a 2-to-1 ratio versus long versus short, and this is the small speculators. In fact, they were short the market, and they made up, and you can see 8.8 versus 16.6, it's almost a 2-to-1 ratio, as I was just saying, but in percentage terms, right, to the overall open interest. So small speculators are short, hedge funds are short, and they're short ahead of the ECB, and we'll get to why that was so meaningful in just a minute. It gave us the inclination that there could be a massive short covering rally, which is generally, for anyone who's short, an extremely painful situation because there's no way out, right? I wanted to reveal to you what's going on right now, and I'm just going to scroll on down here till we get to the New York Merc in the current state of energy, okay? So I'm going to scroll on down till I find what we trade is the light sweet crude And it should be coming up pretty soon, I hope. I didn't bypass it. Here we go. Light sweet crude. How do I know I've got the right one? Because the open interest tells me we've got 2,256,000, and yep, that's the one. Light sweet crude. What are the positions being held in this? As of 12/1, hedge funds, they are short, literally, a 2-to-1 margin. 200, almost exactly a 2-to-1 margin. They're short 253,000 contracts, but 157 entities of hedge funds, that's individual traders, an individual corporation, or an individual hedge fund or commodity trading advisor, is short 497,000 contracts. Look at the small speculator. While they're fairly neutral using crude oil futures and options, I mean, it's not a heavy, unbiased 2-to-1 basis, they are net long the market by a small 6,000. So basically the battle on crude oil is between right now commercials and the hedge funds. So we need to look at what's the typical time of year that crude oil bottoms, number one, from a seasonal perspective. B, what's the current condition, who owns the market, and who's getting it stuck? And that right now it's the hedge funds that have the issues. So, how much can a hedge fund maintain before he has to get out of a position? They were on the wrong side or had to quickly cover their euro currency last week, and now they're getting beat up in crude oil this week. So this might wipe out a little bit of the hedge funds. And when we get to these big moves, when we get to these big changes in the commodity world, right, people only look at what did happen, not how to anticipate what could happen. So I think 2016, number one, should bring a heightened arena of volatility and continued sector and indexing rotation as investors, I think, reallocate assets ahead of election. And we're going to see some of this continued volatility in the investment community. And I think these are the tools that we typically use, and I call it the person's 12-point trading program. Many of you are familiar with the PPS buy and sell triggers, which is easy to scan, and I'm going to set you up with that in just a second. My candle patterns, high close, low close dojis, those are easy to scan too. And then we use our person's pivots to define support and resistance in various time frames. Seasonal analysis is crucial. And I want to warn you right now that we are coming into a little time frame for U.S. equities. Ironically, different stocks, different sectors actually do have a little bit of weakness. We see weakness after the Thanksgiving time frame going into, you're going to love this, on approximately December 16th. Give or take a day or two, and the December 16th coincides with the Federal Reserve. Crude oil is literally days away from a seasonal bottom. That's interesting right there in of itself, because now I'm using tools to help to determine if the market has any further to fall. Are they switching from getting out of their longs? Did they just, we just nailed the week? As you can see, the small speculators aren't really that long, right? They're almost neutral. They're slightly long, and I would have to say with today and yesterday's action, maybe they got stung a bit, and that's wiped out some of the weak longs. So we need to watch over the course of the next few days. And I'm not saying crude oil is going to jump right back up to $50, but I think stabilization is the key word, stabilization. And what we are also finding out, folks, is that there is this other thing that we utilize. It's called relative strength analysis, or you may be familiar with spread charts. Now, I did this before on spread charts and how to use a spread chart or create one. So I'm not sure if there's a bunch, and I'm sure there might be a few traders out there who are Thinkorswim clients, but we could easily take a look at this, a company like RIG, right? Transocean, and we take a look at RIG, and what I find interesting about a stock like RIG is that when we made the lows over here back in August, we haven't seen RIG and a few other names have a new corresponding low like crude oil. So there are certain segments of the market that are actually showing some signs of strength. Now, if you guys want to look at a relative strength or spread chart, we could simply take a look at a couple sectors. We could look at XOP relative to crude oil, right? So, XOP-//CL. I don't recommend this exactly, and if you ever look at creating a spread chart, if you're using an ETF versus the future, it's you just plop the name of the ETF, and the XOP is the oil and gas exploration minus or hash hyphen / crude oil or commodity symbol. What you want to do is go over here to style, by the way, and you want to make sure your chart style, change it from a candlestick to a line chart, okay? That, number one, will give you the relative strength of what you're comparing XOP to crude oil. If XOP, if it's outperforming crude oil, the trend should be going up. And in this case, while the last couple days it looks like it's moving lower, actually the irony is that the XOP is still outperforming crude oil. The funny thing is that we are entering, whether you know this or not, we are entering a seasonal strong time period for the energy. This is like the beginning of the end of the worst time period for crude oils, traditionally. So we need to be monitoring market conditions, meaning what is the volumes like and what are some of the stocks in that sector looking like. So that, I just wanted to explain what the relative strength can do, and then finding out, is this report relevant? And yes, it's extremely relevant. It really is. It gives us an inside look that, hey, as of December 1st, these guys were long that much. I'm going to be watching to see, and again, this is going to be delayed reaction, but I'm going to be watching this over the next couple weeks to see if this number starts to change. If we start to see the small specs finally reverse from long to short, oh my goodness, they get long at the top and they get short at the bottom. And that'll be an interesting, and these are tools that everyone can utilize and should be using, especially when we're looking at particular markets of interest. The small cap, this is actually entering a time period where, and I know there's been a lot of talk about the Russell 2000, and this is the Russell futures, and this is a time frame where we do see a traditional seasonal tendency for the Russell to outperform relative to the other markets. This year, the Russell has not outperformed. But notice using the person's monthly pivots, even with, and I took this snapshot probably, let's see, I'm going to have to say I took this snapshot about 15 minutes before coming in with you guys. So I just wanted to make sure I had a current chart. We are right now testing the fate of the person's monthly pivot support. Supposedly the outlook from a technical perspective is bullish. I want to teach you guys how to properly use the monthly person's pivots. Since entering 9/28 going into October, ironically, it has projected a higher green, a lower red, but it projected the right resistance. It projected a higher red, a higher green. It was giving us more of a bullish bias, and you have to see that the market has been respecting higher lows. The tool underneath is a volume trend tool called on balance volume. This tool is actually indicating that the market, even though we sold off, we're at support, we're not making tremendous technical damage yet on high velocity of volume. That's actually promising, specifically since between now and December 16th, we typically see this market or this segment of the market bottom out and go higher into January. It is my contention that even though we have a strong influence of a few items that weigh in on the Russell, small cap oil drillers, we have small cap biotechs, and of course regional banks, small cap regional banks. Those three areas right now are under pressure for two reasons: the fate of the dollar, and of course interest rates. And again, we all know what happens. Interest rates pretty much dictate money, and money makes the world go round. This is the euro currency. And what I look for, a setup that I look for, and something that we were talking about several times and for weeks in our trading room. It was almost like I know I was being called the boy who cried wolf, and many of you probably attend if you're a TradeStation client, you go to the morning briefings on TradeStation. Every Thursday I do these morning briefings, and I kept saying, guys, the rate of change, the pace of price change is not diminishing in the euro. In other words, we're not making substantial new lower lows, and the volume is forming a convergence, a bullish convergence. So if you take a look at this yellow line, and if I told you the yellow line was price, it has a significant higher high over here than it does over here. It has a higher low, right? And price is equal or just about absolute lower than this corresponding level. So when I say, well, and we're also near a monthly pivot support. So when I see that, and I look at that convergence, and then I go back and I look at this report one more time just to share with you guys. How do we give ourselves that added boost of confidence? How do we get and put it all together? How can we sit here and say, what's the best, biggest trade that might be coming down the pike? We've got a market that, by the way, many of you might not be aware of this, but I did contribute and put a lot of great ideas in this book called The Commodity Trader's Almanac. The last issue was 2013, but one of the studies that I brought to the table was doing a backtest study and a synthetic valuation on the euro currency using the Deutschmark, the French franc, Italian lira. I mean, you take those three currencies and pretty much you got the euro currency. And doing a backtest study over 25 years, including the euro with its new calculations and the old synthetic euro valuation, we did find that there was a strong seasonal tendency for the euro to rally from November into year's end. So from a seasonal perspective, we were armed with some inside information of some upside. So if you don't have that information, how can it help you? Well, there are several tools and ways to find seasonal analysis, but here's what really makes the difference. I always teach my class and my students, seasonal analysis is okay, it's good, but technicals always supersede seasonal analysis. The stars have to kind of line up. How can we anticipate the market to explode to the upside? We have a volume convergence pattern, which means the sell-off is light volume, and it is a big-time setup for an upside sharp, fast move. And the market was locked and loaded with shorts that if this thing started to move up, these guys would start to scramble. This combination is a very powerful setup. So in the sequence of events, just to refresh everyone, A, you look at seasonal tendencies. B, you look at the technical condition of the market. And then C, if it's a commodity-based ETF or a commodity-based product, look to see who's in charge of the market, who's got their fingers in the till, long or short. And that may help us understand what's going on when the market, so that you can prepare for a potential move. And then as an option trader, this gives you some really great inside information to take advantage of a directional strategy. Ironically, right now, small speculators, these guys are flipping left and right, back and forth. We have small speculators, which they always tend to be buying up at the top and getting short closer to the bottom. And the hedge funds. Now, I've got E-mini S&Ps here. It's one of my favorite tools, and I'm just sharing with you as of December 1st. What is the overall condition of the market? Open interest is 3,400,000, so it's not great. It should be in like closer to 4 million. So it means we don't have a whole lot of people trading, but the ones we do have, we have a small bias to the short side for the small speculators, and the hedge funds are actually short, but not by a great percentage. It's actually, even for the hedge funds, by their standards, 9.1% to 11.9%. That's like darn neutral. And so is this number right here, 9 to 10%. You can see that's like almost neutral, right? But there is a bias to the short side. So there could be a short side squeeze. So this coming Friday, we're going to get the new updated report, ironically, right ahead of next week's Fed. And if we see that they've increased their bearish stance in this time frame, and the volume gives us that same type of potential convergence pattern, I would suggest that next week we might have another euro currency setup one more time. Now, I want to share something with you. This is kind of, I mean, unless anyone got the memo that there was going to be a buyout on Green Mountain Coffee Roaster, the irony in the trading room, we kind of joked about this. I have a long kind of distaste for Green Mountain Coffee Roaster machines, Keurig machines. They tend to break. And jokingly, I went out and bought a new one for the office. I don't know if it was here or here, one of these 2 days. I can't remember. Maybe one of you guys that are in the room can fill me in on the blank. But we did make a little bit of a strong bullish convergence, and this is one that the stock typically has a seasonal upside move. But the key is on Green Mountain Coffee Roaster, it was developing a little uptrend, and the volume was starting to really surge before the announcement came out yesterday on Monday. So there was, maybe people were just maybe buying because it was near pivot support, or maybe they got an uptick in volume, or they saw the fact that we had a volume convergence pattern. Either way, it's there on the charts. Whether you traded it or not, it's there in the marketplace. Some are more exaggerated or bigger moves than others. But when I look at running scans, and I know many of you are thinker swimmers, so I'm going to just share, you know, when you run scans, you know, I can look at whether I want to look for buy signals, sell signals. In the next couple days, the next week, going into the Fed, I'm going to be looking at running more Russell daily buy signals, right? I'm going to run scans to find out how many stocks generated a PPS buy signal. What is the PPS buy signal? What the PPS buy signal is it's about 10 different things there's algorithm, there's 10 different factors that occur that need to generate a buy signal. Now, this is actually after today's action in the overall market. Today we generated, as you can see here, out of the Russell 2000, 30 buy signals only today. What were the sectors? We saw healthcare, retail, healthcare, household, real estate, biotech, which is healthcare, biotech, semiconductor, Rudolph Technologies, by the way, up 13 cents. Beverages, hotel, specialty, food, pharmaceutical. So we got the idea that there was some small cap, not a whole lot, but there were some buy signals that populated on a concentration of healthcare and biotech, right? So I can run that scan tomorrow and say, well, if they're adding to that sector, this method is going to help pick that up. Now, let's find out together live what we got as far as sell signals in the same sector. So we're going to find out whether or not today's price action inherently was generating more daily buy signals or generating more sell signals, and I'll get to the point in just a second. As soon as this thing, you know, calculates. Matter of fact, to save time, because I know a few of you mentioned you had to leave, and I get that. It's been a long day. Running scans helps us to determine overall strength of the market. We also run scans on the TradeStation application, but we've taken it to a whole new level, right? I run, as you can see, scans for high closed doji, low closed dojis. Incidentally, running scans to find out, and this is live, by the way. I wanted to do this for you guys special. Today, and you can see the format, I just ran New York Stock Exchange, okay? In the NYSE today, I ran the scan at just before we started, 4:13, just to do my homework for you guys special. Look at the scans on the NYSE, and let's see what generated the concentration of buy signals. The first thing you're going to probably see right off the top is financials, right? Financials is probably the number one segment of the market that generated buy signals. That's pretty interesting. Financials. Now, what does that buy signal mean? Well, this isn't just any buy signal. This is actually a filtered buy signal that I run that says, show me a stock that's in a daily buy mode, that generates a daily buy mode, while the weekly's been in a higher degree time frame, the weekly's been in a buy mode. In other words, if the weekly chart generated a buy mode, I want the computer or the program to show me when does it generate daily buy signals. I don't know, Nuveen, BlackRock, we could take a look. Now what we have to do is a couple little things. We got to filter out some of these little low volume guys, right, and low cap stock. But here's a company low, right, and you can see volume looks good. You know, I'd want to see more stocks in that sector join the party. But AIV, a real estate investment trust, it's in a buy signal. You know, so it's kind of almost in that interest rate sensitive sector as well. So running scans does a lot for me. It helps me to qualify whether or not and where the buying pressure came from. All right, that's pretty cool. Here's another thing that we want to look at. Remember I was showing you the Russell, the TF? This is actually an advanced decline cumulative indicator that shares with us what the health of the breadth of the overall Russell 2000 is. And while it might not look great, and with the heavy pressure of crude oil, the heavy pressure of financials, and the heavy pressures of biotech weighing in on this sector or the market right now, what I find interesting is if we go back together, just to give you a lesson, and this is very teachable. This is real easy stuff to learn. Very easy. It helps give us a quantitative, factual look at the market rather than an opinion that, oh, the market crossed below a moving average, it's going to go down. What I want to know is, yeah, it crossed below a moving average, but did it go down on heavy volume? And did it go down with the majority of stocks crashing? Because if it went down with strong participation in all sectors of the market rather than a few sectors weighing that index down, then maybe it's giving me a false reading. So the funny thing is, even with today's action in the Russell, we hit this longer term pivot support in here. Yeah, the volume did come down, but again, the market's negative. You can see it's negative today. So we had more negative volume, and yes, the breadth was negative. But question for you, where are we relationship with the current price and the last low price in value? We're not that far away from the, just to tee this up for you, on November 17th, we had the market close at 114.61. That's not far off from where we were today. Would you agree? And on that same day, relative-wise, we're not quite there in volume, and we're certainly not quite there with the advanced decline or the participation rate. This what we call the advanced decline. So the Russells actually, believe it or not, could be setting up if everyone's getting bearish the market and everyone's starting to sell the market. The funny thing is, or majority of people, let's put it this way, not everyone, the actual underlying technicals is not giving me that fearsome buy put attitude right now, right? By the way, today in the Qs, it's ironic. You can see clearly where the market's still closer to its highs, not its lows in the NASDAQ, with biotech and everything else that's running rampant in that sector of the market. The volume actually did look and appeared to do a pretty decent job of holding up. If you could look at this yellow line, it did make, and it has a pattern, what we call a zigzag of a higher high and a higher low right in here, right? We made a higher high, but price did not yet. The AD line, and this is the advanced decline, it's still not moving up, but it certainly didn't move down. So I can't really say that I'm ultimately bearish in the market right now. However, let's take a look at the Dow Jones Industrial Average. So not to confuse you, but to just share with you that the market is going through a transitional sector and indexing rotation. look at the volume, look at the price, look at the corresponding volume, look at the corresponding price. We are actually a little higher than we were here, and the volume is a lot lower than where we were, right? I mean, it is clearly lower in the breadth of the market. The volume is certainly making lows, right? So we see a market making, this is the Dow Jones Industrial Average. This is, of course, something that's a little spooky to me, where we see a lot of indexing going on, index rotation, certain segments of the market. Majority of stocks fell today in the Dow Jones Industrial Average. That's what that shares with you, on some pretty significant volume. This picture, forget the price. Look at the indicator, a volume indicator and a cumulative total of the advancers versus the decliners. Then look at this one. We're not making new disastrous lows. We're certainly not making new disastrous lows. So actually, relative to the Dow or the blue chips, the Russell is outperforming right now. So I would not be looking to shed any ideas that the small cap sector won't see the January effect this year. These are the tools that I use to help me uncover hidden support and resistance. All right, this is the scan we ran today on the Russell. We just did this and just finished doing a PPS study for us here using Thinkorswim. Let's take a look at industry. What generated sell signals today? Thrifts, pharmaceuticals, machinery, media. We take a look at this. We had 102 stocks. Well, we only had 30 buys and we have 100 sells. That's not healthy. Banks, it looks metals and mining, banks, has some healthcare in here, thrifts, mortgage, which is financial, capital markets, more financials, insurance, which is considered in the financials, banks. I mean, I'm going down the line. So I'm finding the banks. I mean, look at this. This is like crazy, right? And a couple airlines, Virgin, American Airlines got smacked today. But this kind of tells me, doing it and running my own scans at the end of the day, when I'm thinking a market, and this is the connect the dot aha moment, when I'm looking at a market that should start to enter a seasonally strong period of time, is it locked and loaded with everyone on the wrong side of the market, number one? And number two, I want to run scans to see, are we seeing corresponding stocks in certain sectors of the market giving me the support that now the market's ready to run, okay? The person's pivots, these give us indications on a futuristic. It is one of the best, what I call leading price indicators in the marketplace. It's leading price indicators because it's calculated at the end of the time period. I use the dailies to help me time market entries. We use the dailies to not just help us with timing, support, and resistance, but also to give us a category of, is the market giving us a bullish or bearish outlook for the next day. And how do we know that on Thinkorswim? Well, typically when you get a higher red and a higher green, it's giving you a forecast at the end of the day for the next session that the market's giving us a bullish outlook. When we combine that with another very powerful tool, this volume analysis, and we start to see a trend rise and the price comes to support on a bullish day, it gives us the indication that we're going to probably get more upside by taking buy signals than trying to scalp the short side of the market, even for day traders. So the idea that I've always had, and there is a lot of things that are coming to change in 2016, is absolutely going to be I think a whale of a year. And Janet Yellen is going to start it next week, and the market's trying to anticipate and prepare for it right now. In fact, everyone's trying to prepare for it right now. At the end of the day, no one really knows. We're going to see what's going on. I personally think, since the Fed backed every investor to get, instead of a rate of return in a CD or a T-bill, remember that term, a T-bill, an actual treasury bill? Can you imagine putting money in a 6-month T-bill? How many people remember that, right? Or the negative yield, paying the bank to hold your money if you were in a LIBOR. That's just crazy times, right? But the Fed made us, if we wanted to have a rate of return, buy stocks. And maybe that's what the Dow was reflective today. Interest rate sensitive stocks, high dividend yielding stocks have principal risk right now, whereas small cap stocks might not have principal risk, but there's still overall volatility market risk. I think it behooves us to look at the condition of the market. Is there strong volume on the sell-off, or is there market convergence, meaning the sell-off is on light volume? And that'll help us be more directional rather than a non-directional. Another way of trading this, and the tools that we had some aha moments with some new students and some old students, was instead of day trading and using some of the techniques that I've just gone over with you guys, when the market gets near like a major support and it's on, all of a sudden we start to see an uptick, selling out of the money, weekly SPY credit put spreads on a market buy signal is another way to kind of capturing market capital for short-term type trading. But the really big game markets, I think, can be found, believe it or not, and I know you're going to kill me, but the really big money is not by doing, option strategies. And the word strategies involves multiple legs, condors, for example, wide verticals. It really is being directional and having open-ended net long or calls or net long puts, meaning you're looking for a market to crash and you're in outright puts, or a market to go up. This requires a science and an understanding of timing tools. If one does not have an understanding of timing tools, then using the traditional option writing strategies will work day in and day out. But if you're interested in learning more about timing tools that we can put together that have a defined sense of excitement and a high degree of probability, then I think it's easy to learn. And the tools, I have no new message. I don't think I've changed my message in years. It's just the only thing that's really changed are the conditions and the players, such as who's the next running for office of 2016. These are the things. Every year we kind of go through the same kind of thing. Some years we have bigger moves and some years we don't. Again, what happens in equities is a slightly more complicated than that, a little bit, in the nature that we get companies that run other companies out of business through destructive innovation, i.e. Apple. Apple put a lot of people out of business, right? A lot of industries. Look at what's been going on with Amazon. Amazon flourishes, and hardcore brick and mortar department stores like Macy's or Best Buy or Nordstrom can't seem to do much right in the last 6 months, to say the least. So any event, I think that it's important to remember that options trading is about probabilities, not certainties, no matter what you do. But I think we have a really neat combination way of teaching and sharing people some heightened probabilities of trading and putting things together. My work helps option traders gain, without a doubt, superior analytic skills. There's no doubt about it. I think they're just working a little bit harder makes us a lot luckier. I think we help traders anticipate market opportunities a little bit better. I think also we help traders make trades based on facts. And the facts are not what the media says. The facts are what the market conditions and the indicators show. And I'm not talking about MACD. I'm not talking about RSI. Those are Bollinger Bands. Those are all price-based. We have enough price-based indicators out there. And it might be good to look at, implied volatility, and that's nice and that's great. But, I think looking at the overall condition of the trend of the market really seems to be, and understanding when the best time of the year we seem to have markets bottom out. You know, we're coming into a couple stocks, by the way. Now, I don't know if they're going to see really big moves soon going through year's end, because stocks that are near 52-week highs tend to stay, or, you know, near their 52-week highs, because no one wants to really take a lot of profits off the table, you know, and have that tax consequence to write the check on April 17th. On the other side of the coin, stocks that are near 52-week lows or near their lows, they tend to stay down. They don't really tend to recover much because fresh money doesn't seem to really want to come into, you know, high-risk trades, and anyone that hasn't sold may sell to take that tax loss credit to offset some capital gains for the year. So that's the essence of what happens. But I want to make mention, there's a couple names, some that we're stalking here. One's Transocean, which has, you know, and I'm going to go through that right now. Just ironically, let's take a look at rig real quick together. I mean, this is a, I would have to say, I'm not sure about what you would define as a the abyss of, you know, as a stock investor, but boy, that thing fell off the cliff. But I find it interesting, and it has been falling off the cliff longer term. This is a momentum histogram indicator. It's forming a longer term bullish convergence. Notice as it's fallen off the cliff, the volume indicators not making newer lows. I find that, I don't know about you, but we find that to be kind of an interesting concept. Looking at this stock, and I have to really zoom this thing up, but in recent history, in the last, say, 6 months or so, we've seen some increased volatility out of rig, Transocean. But as the market starts to move down, and as it moved down earlier back this in August, as the market made these lows, it wasn't making significant lows on any specific volume. In fact, if you can see this histogram, and it's hard to see it through this ghost image that says view data window, but I apologize for that. One of the things that I want to share with you guys is it's not just rig. It's a lot of stocks in this category or this sector. We're starting to see, I mean, this is not a very positive picture, and I guess I could show the resistance and the trend of the overall market going down. What I'd like to share with you, that relative strength that I was referring to, this actually kind of tracks crude oil prices. But as the market's moving down, it moved down with a little bit of volume, but not with a whole lot of volume. It's actually forming a potential convergence in the marketplace. Let's take a look at the daily charts here. So if we take a look at the daily chart, you're going to see that first and foremost, we're near a pivot support, number one. Number two, we are making newer lows. It's like the euro currency. The rate of change is not tremendous. It's not making great, bountiful strides and trending and crashing. Crude oil's making new lows, and yet this company's not making new lows. So relative to the energy complex, it should be making new lows, and it's not. What happens if crude oil bounces up, or we start to enter a seasonally strong period of time for this particular stock? It could see an amazing upside move because they're not selling it off on a tremendous volume. So rig is one that might have, in the next 90 days, 120 days, some powerful upside to it. And as we are looking at the energy, I'm not saying ever go out tomorrow and, you know, get massively long rig. But what I am saying is that we are getting, you know, a lot of these setups, all right, setups that we're entering some seasonally. It's that time of change. And while everyone's focused on the now and the has been, people tend to forget what does typically happen. Yes, every year is different. Yes, there's maybe more oil coming on the market. Yes, OPEC just voted. Yes, there's this problem, that problem. But you know what? We all see what the problems were. No one ever sees what the solutions are. And that's where we look at the conditions and these tools, and to combine these things together, that helps give us a strong edge in the market. Now, I am going to offer you guys an amazing trading lesson for this year. and into the new year. And it will cover a lot of things. And I can't believe we're doing this, but it is something we are doing for $126. I didn't come up with that number, but it's $126. $126. We're going to have 3 mentoring sessions, and here's what we're going to talk about. How to use person's pivot study, the momentum indicator, the arrows, the most effective time frames to use, and understanding certain moving averages using my person's indicators. That's the first session. The second session on January 16th, how to set up the person's scans using the person's indicator and how to use the scans to combine it with sector analysis. The third session, January 23rd, is how to integrate volume analysis with the PPS indicator and specific volume analysis indicator. There's a word missing there. The link that you guys should use is right there at personsplanet.com. This is something you should absolutely do yourself a favor. Take if you're a day trader in the market right now, okay, if you're a day trader in the market, after commissions and fees, you're talking about 10 ticks in the S&Ps. And I promise you, this will be one of the most powerful sessions that you go through, and it will not be a waste of your time. This is not a fluff piece. I've never stopped for a fluff piece from anything I've ever done in the educational field. Most of you know that. So students out there, this is the one that you can absolutely get and sink your teeth in. It's a great refresher course, number one. Number two, I think for everyone out there that's not really taken the step to say, well, I've seen John and I don't know, I've gotten something out of what he's talked about. You know, we put together the whole thing that launched this candlestick and pivot point trading triggers, that book right there. It's 10 years old, and everything in that book is applicable today. Everything in that book is something I've shared with you. It's even been developed on Thinkorswim, the PPS indicators, the last conditional change. But anyway, here is the link that gets you there to the how to use the PPS, the 3 lessons, these mini mentoring sessions. This is an incredible. Take this up, go through this. This is going to be an incredible class for January, doing these on Saturdays. Yes, they're going to be recorded, and yes, you have access to this. And we will go over, David Kushner wants to know, will we go over day trading? You know, one of the most powerful things, David, is how to utilize these techniques in day trading. And the advanced trading system that we put together, intraday. Look at these 2 tabs here, equities, intraday, okay? So whether it's for stocks or whether it's for futures, how do we combine whatever you want to use? Bond market, how do we utilize the right time period? You'll see almost every single chart we have, 5-minute, 15-minute, doubled up on the 15 because I always like to expand a 15-minute chart. Looking at the bond market, for example, 30-year bonds, and that's another thing that's coming to change, kids. I can't give you everything all in one time, but look at this. Almost everything I talked about today in one click, I've just put together. This is the Commitment of Traders report on the 30-year Treasury bonds. By the way, you can see how the speculators get. Look at this, the biggest net short position. Yellow is small speculators, by the way. Look at the yellow line and look where the bonds are. I mean, this is a sad story, but for the most part, the small speculator, they're like the shortest they get ever in history at the low of the market thinking it's going to crash, and then the market rallies, right? They finally decide to get long. This is a sad story. Look at this. They're short all the way up. Below, this is a zero-line histogram, by the way. Zero-line histogram. Anything below it means they're short. Anything above it means they're net long as a group. They finally decide after being short the whole way up to get long right near the high of the whole move. And then finally, when the market goes down, they get convinced to finally get short the market. I mean, this is a sad story. It's good for people that want to learn how to do this and use this tool efficiently. Why? Because for every buyer, there's a seller. For every winner, there's a loser. And we need people to be losers. But as a group, small speculators tend to buy high and sell low as a group, and this Commitment of Traders report reveals that. You know, ironically, they were short right at the lows several weeks ago, and then they decided to flip going into the long up here. That's a little scary, but it's not a huge net long position. Now, the Fed meets next week, and by the way, we're kind of hoping to see a rally up in here because the worst time of the year to actually get long bonds is in the next 10 days, by the way. So as you can see, we don't have any trigger on a short trade yet. Volume's not appreciating. Of course, price isn't appreciating anyway, but I wanted to just quickly review that because, yes, these techniques are extremely valuable, something we use every single day, day in, day out in our trading room for day trading, and we will be covering that, how to utilize these tools effectively. But more importantly, I think that the concepts that we have putting together the first, second, third session is just a great way to spend Saturdays, get you out at shoveling, and that's exactly what we want to look at. Anyway, I want to say a couple questions came. What exactly is a person histogram? I think I covered that. The person histogram is a reflection of momentum between the proprietary moving averages, price to those moving averages, and the relationship of the moving averages themselves. So for the question that was asking, what do I mean by that, is simply this. So looking at the S&Ps, let's take a look at the S&Ps. I'm going to plop up a 15-minute chart. So as the market's moving down, can everyone see the market is moving lower, right? The histogram is starting to do what? Move up. And it's showing that that bearishness is starting to wane. And so all of a sudden, as you get into the market's activity, we're starting to see the market lose that negative momentum. What that reflects is what is the relationship to the price move away from the moving average, and what is the moving averages? What are they doing? Well, you can see that the two moving averages, they were really far away, and you could see that the bar, the red bar, is way far away from the moving averages. And all of a sudden, the ranges start to contract, the moving averages start to narrow, and that shows the negative momentum is starting to dissipate. So that's just a quick nutshell of how that momentum works. Okay, I hope that answered your question. That was for, I don't know if that was another guy named JP or someone who was asking a question for JP. And then Gina says she likes the strategy of selling weekly options based on, you know, markets trading around the pivot, support, and resistance. Any event, I was saying, John was saying short on oil. Did he mean long? The longs were larger. Yes, I was saying that on the crude oil, I was saying that we enter a seasonal time period next week of long crude oil. Let me get into crude oil real quick. What I was sharing with you on the Commitment of Traders data on the, real quick here, guys. Let's go back. Close out of that. We'll start from the beginning. All right. So here's the beginning. Person's Planet, Tools, COT report, 1 click. Get report, 2 clicks. All right. Let's scroll down. What I want to look at is futures and options. And I want to go to the New York Mercantile Exchange short format because I don't need long. And I'm going to scroll down to until I find crude oil, light sweet, 2 million. There we go. We got the right one. The hedge funds are net long the market. 497,000. They're short 253. So they're net long the market. The hedge funds are net long. The small speculators are net long, 96 versus 90. 90 from 96 is 6, so they're 6,000, and you can see the percent to open interest, 4.3, so they're 0.3% of the overall open interest long. A neutral position for small specs, by the way. But the hedge funds, That's a 2-to-1 ratio. 11.3 versus 22 is almost a 2-to-1 ratio. The hedge funds are getting taken to the cleaners right now. The hedge funds are getting taken to the cleaners in crude oil. So they're long the market. What has the market done since December 1st when this report was revealed to us? So let's go back and look at a daily chart and go back to December 1st. So the 1st, as of Tuesday, come on, person, here we go, 41.85. And the market has a low of 36.64. So almost approximately a $5 move, $5,000 contract per move. These guys, the hedge funds have taken, and maybe they're not all washed and rinsed right yet, okay? But that's a $5 move in a very short period of time, and that's after they were, what? Short the euro currency, and they got that one taken to the cleaner. So how much more can a hedge fund take before, they puke the position out? And when they puke the position out, that's when we're going to be looking at the condition of that downside action to see if we get a volume convergence. And the best thing is, from a seasonal perspective, we come into seasonal strength in crude oil mid-month. So they were long, they get out, then the market hasn't, might find some stability. So anyway, I just wanted to go through that with you guys, and from top to bottom, and just to really give you guys something to sink your teeth in for the new year. We're coming up fast and furious. I know everyone's going to have big holidays. Sign up right now. I think actually you'll get access to what I think we will send to you guys too, is what we put together as a very special report weekend for our members. It's called My Weekly Positive Thoughts and Observations. I think it's very important to read this because we go through factual data of the condition of the market. We give you what the market shows. In fact, it shows, what we were writing about in here. And I still think that, and I remain, since I have since September, by the way, and a keyword, cautiously optimistic, that I think all stock indices will remain positive territory at year's end. Most of them are, except for, of course, the Russell and the NYSE, but we are vacillating. The NASDAQ's positive on the year, of course. The S&Ps are positive on the year. The Dow's teetering to almost being back to positive on the year. After the Fed, then we've got 2 weeks of, God knows, a quick move, and then we'll move over from there. But for equity traders, we really cover the gamut. Really great information for commodity traders that want high probability trades. We go through commodity spreads. I give defined scans, what we're looking at, weekly high and low close dojis. And again, condition of what I see are conditionally entering seasonally strong sectors, broker-dealers, biotech, gold miners, material, housing, and energy. And I think energy, these two sectors, opportunities exist for credit put spreads waiting for the setup to emerge. And so while we're not looking for a huge upside, we are looking for stability in the sector, which is different. So any event, of course, do be prepared, by the way, tonight. I want to make mention of this, you guys. We have China's CPI and PPI. I don't think there's a problem with inflation in China. I don't know about you, but I really don't think so. But I wanted to make mention at 8:30 tonight, we got a report out there. For the rest of the week, Bank of England, I don't know if they're going to make a huge influence. We do have the crop production report, but this might be something to sink your teeth in on Thursday night, just a heads up. China retail sales, 7 p.m. That might be something, and again, we get our U.S. retail sales. That might be something to consider, all right? Apart from that, I found this to be an interesting stock earnings for tomorrow. Not only we have Costco, but Lululemon, Men's Warehouse, but this guy is called Mary Jane. It's in Denver, Colorado. I don't want to spread holiday cheer, but these guys are a bed and breakfast that, it's kind of like Napa Valley, but not for wine, if you get what I'm saying. Anyway, MJMJ is the name of the company, I believe, if I remember, is called Mary Jane. Anyway, listen, I want everyone, if we don't cross paths until New Year's, have a wonderful, safe holiday once again. And everyone, I would sincerely urge you to take it to the next step. Get on the right side of the track. We're going to have amazing blast-off moves that I want people that you can be prepared for. Even if it's buying, I think, as we are seeing, it's like what we call the all or none syndrome. Nothing happens, and then bang, market explodes. And if you can anticipate some of those explosions and just have, the right options on and participate in that, you're going to make 2016 a real great year. So with that said, everyone, have a great rest of the year. We look forward to you guys signing up. Be there. It's going to be a great event, 3 weeks with me, Saturdays, question and answer, and we'll go through this top to bottom. So with that said, everyone, happy Merry Christmas, happy holidays to everybody. And for my own community, I'll see you here tomorrow. Click on the link. It's right there in the room. It's called Persons Planet. You can get the 3, just go to Persons Planet, use PPS. I'll type it in once again. It's Persons Planet, use PPS, and just click for $126. This is just a great way to spend 3 Saturdays learning fabulous indicators with me and putting it all together. I'll see you there right after the New Year's, everybody. Take care. Thank you, everyone. And again, happy holidays.